Okay, today we have Roxanne Martino with us. She started her career at Coopers & Lybrand. As a senior manager, she was there for 7 years. She moved on to Grosvenor Capital Management, became a general partner. She was there for 6 years, and she joined Aurora Investments in 1990. She is currently the president and CEO. The Aurora Investments manages over $8 billion in hedge funds, has a proprietary database of over 8,000 alternative investment managers, and invests with 60 managers around the world. Also managed 4 onshore partnerships and 4 offshore funds. She is a 1977 graduate of Notre Dame, Bachelor of Business Administration program, our college right here, and has an MBA from the University of Chicago in '88. She is the current chairperson of the Mendoza College of Business Advisory Council. For those of you that don't know, the Advisory Council is a group of 60-plus businessmen and women from around the country who give us advice on what should the College of Business be doing. What are the kinds of things that you need to be prepared for when you go out in the business world? The council is very influential in helping us to make those kinds of decisions, plus they're very supportive from a financial aspect as well. So we really appreciate the efforts that Roxanne has and her willingness to volunteer her time to be the chairperson. That's a very time-extensive type of opportunity. She's also a member of the Executive Education Advisory Board here in the college as well. She is a member of the Economic Club of Chicago, previous director of the Investment Analyst Society of Chicago, member of the American Institute of CPAs and the Illinois CPA Society. On her civic responsibility side, she's the director of Thresholds, a Chicago-based not-for-profit rehabilitation organization, serves on an investment committee for the board of directors of Catholic Relief Services, and a board member of the Children's Memorial Fund. In her spare time, she's authored a chapter, The Due Diligence Process, in the book Hedge Fund Strategies. She's married to Rocco Martino, has 2 sons, Tommy and Daniel. Actually, I've been corrected. It's now Tom and Daniel. Tom is a little bit older. He's now in 6th grade. Daniel actually graduated from Notre Dame as a finance major in 2007 and is now currently working in New York. Roxanne, the floor is yours.
Thanks very much. Well, thanks for coming. And when I read the review of what this lecture series was, it said it would be interactive. And so I'm going to leave plenty of time for questions as we go through. The hedge fund industry is one that tends to be a bit controversial in the press, at least, and so I usually get a lot of questions. But it really, feel free as I'm going through things, if you have questions about the industry, my career path, anything really, just save those and we will go through everything for you. What I thought I'd cover today, when looking at some of the other speakers that you've had, I think my career path's been a little different in that it's been entrepreneurial. I started a business, an investment business, and so I thought I'd go over a little bit about that, actually building a business. Running an investment firm is very different than running a lot of other businesses, manufacturing or other things. It's a very unique type of place to lead. And so I'll talk a little bit about that. And then, of course, the hedge fund industry, the fund of funds industry we'll cover, which is the industry I'm in, alternative investment strategies. And then I thought you'd be interested in where are the opportunities today. After the dislocations of 2008, there really are a tremendous amount of investment opportunities, which I'm happy to say when you're entering the workforce, while it will be hard for you to get a job probably, once you get it in the investment field, there's going to be a lot to do, which is a nice place to be in the long run. And then I'll leave that time for questions. And so to give you a little background, I've been managing Aurora one way or the other. It was my client initially, but for the last 22 years. So we're in our 22nd year of running the investment firm. But I followed the hedge fund industries for over 30 years because even when I was at Coopers & Lybrand, I was an auditor, and back then the industry itself in the late 70s and early 80s was a new industry. And so a lot of the managers were commodity related, and I was the auditor covering those. So I've been in the industry for over 30 years. Because it is a new industry, I'd say that you're not going to find very many people that have been around that long. And so even if you have questions about the history of the industry, I actually can help you with those. So I thought I'd start with first, before we go into the industry or the firm, kind of the basics of you're starting out. It's really an exciting time for you. You have everything before you, every road. And I think there's a couple building blocks to make sure that you are a success, and they really are the basics. And one is that you're all given so many talents. If you are here at Notre Dame and you have been given a lot, and it's not just a brain, it's probably common sense and good judgment and a probably pretty good heart. I think the most important thing for you as you go through life is to use those talents. Sam described some of the things I'm involved in that are not related to my career path. And I would say fairly early in my career, you get involved in some of these charities or some of the educational institutions, be it high schools. Catholic high schools need a lot of help right now, and I've been really involved in too and remain very involved. But you realize that you've been given a lot of gifts, and spending time on some of these things makes a huge difference. And over the years that I've been involved, I realized that the ones I want to stay involved in, when things are happening there, I feel like often if I wasn't there, if I wasn't in the room, it would have happened differently. And so it's worth my time to do that. So I encourage you all to look beyond your careers and use those talents to do a lot of not-for-profit work. It's very rewarding. And on the other side, I've met so many fascinating people that have actually helped my career through that too. Many of my investors, kind of funny as life goes on. But the thing about success is you really have to set yourself up for success, whether it be education or training in other ways. If as you start your career you find that you have areas that you need some help, go take a class at night or ask your employer to pay for some training. Set yourself up for success in that area. Now, as life goes on, I think the most important thing for long-term career success is you have to find an area you're actually interested in. So often I see people that are going into an area because they feel like everyone wants them to, be it their parents or, they have pressures to succeed. If you don't have a verb for the area that you're in, you're never really going to be that successful. And sometimes we do get young people where they don't have a natural affinity to it because they're not that interested in it. If you're really interested in the field, people won't have to say to you, you need to ask questions when the managers come in. You will have that natural, you will want to know more and more and more, and it'll come naturally. So I encourage you all, if you find yourself in an area that you're not that interested in or not that good at, just change. When I came here to Notre Dame, I was a pre-med major, and I think it took me about 6 weeks to realize that of my study group, there were 2 people who should be doctors, and I should figure out what I'm good at. And so I moved to the business school and took all these classes and found accounting was it. I loved it. It was easy. Everyone was dying, and I thought, I don't get it. This is pretty easy. So find the area where it's natural to you. Don't try to force it. One of the things is you have to decide if you do have an entrepreneurial spirit. Do you want to start a business? That's a big decision. The difference between entrepreneurs and people who can't really take that leap is that there's a big risk that you take. You may devote enormous amounts of your time to something, and maybe it won't be successful. When we talk about my business today, and I manage about $9 billion, and it's a very global business, and we're in our 22nd year, it looks like, whoa, that was easy. But think about this. It took me 13 years to raise my first $1 billion. 13 years. That's a long time. It took me 13 months to raise my next $1 billion. So, you have to lay that foundation, prove yourself to the world, establish yourself, keep doing the same thing, and do it as well as you can. So that's that's what you do. You build a business. Then, now you have a business, whether it be a small one or a large one. Leading that business through the many changes you'll have to do is the most challenging thing to do. I believe that being a leader, you have to be the good example. And so I do lead by example. I think the most important thing that a leader can do is be fair. I don't think that people really mind if you're tough or if you're give them some feedback that will help them in the long run, as long as they feel like you're fair to them. And so I pride myself on being a very fair person and very straightforward. I give people a lot of rope, but I give them a lot of time to be successful. And obviously I'm working with adults, so it's their responsibility to do that. But to lead people and to guide people's career for long periods of time, you really have to get everyone on the same page. And so you want everyone pulling the oars, going in the same direction. They have to be on a mission with you. So fairly early on, we decided we would have a mission statement. You know, I had all these thoughts, and I have partners. I have 6 partners. We knew what we wanted, and as the firm started growing and you start hiring more and more people, you realize, you know, there's a lot of new people here. We need to really communicate what we want to do. And so what we decided is we wanted to be a premier investment firm. And so we didn't want to be just successful in asset growth. We also wanted performance. We wanted very solid performance. And so we wanted to be the Rolls Royce of the business. And when you communicate that to people, there are decisions that people make all day long that's affected by your vision. Do you spend money on this IT software or this one? If we want to be the Rolls Royce, you want the best system. We have a very long-term view. The other thing is that while delivering consistent, superior results, I wanted it to be a collegial environment. There's a lot of investment firms that are very dog-eat-dog, that you get ahead by climbing on the top of the back of someone else. I did not want to spend my life like that. And so I wanted to make sure that when we are hiring people that realize that the most important thing they can do is train the people they're working with. And the joy was we had a growing business. And so you have enough room. So if someone is not doing it right, it's more important for them to come forward and say, this is what occurred, this is how we're handling it, this is what we're changing, or this is how we train them, and then to bring everyone up. And that's what I communicate even in hiring. We want all of us to be better the next year, so we need to help each other to do that. And ours is an industry that there are no real textbooks. So we have to teach everyone that's coming in. People can come in with obviously some mathematical acumen, which is definitely required, but I want judgment and common sense, and we can teach them the business, but we have to all do that and help each other. So we want to have an environment that is positive, collegial, and we want to have respect for each other, teamwork, as I explained, and then, of course, integrity. In the investment business, you know, all you have is your reputation. And so any person that's working with you can really screw up your business for a very long period of time and maybe actually destroy your business. And certainly over the last 30 years, there's been a lot of examples of that. So culture is very important. And then matching the hiring to the culture, of course, is really important. So now I thought I'd move to the hedge funds, and this is really just the basics, and I know there's a mix of understanding of our industry, and so I'm going to go through this pretty quickly. But most hedge funds are either onshore for U.S. individuals or U.S. entities, or offshore, and that can be for non-U.S. people or for tax-exempt. So a pension, a profit-sharing plan, foundations would go in offshore entities, and that's to avoid unrelated business taxable income. So tax-exempt go offshore. My business is about 50-50. About half of my clients are from the U.S. and about half aren't. Now, a lot of people say, oh, the hedge fund industry is so secretive, and the press always puts that slant on it. In fact, we're operating under very strict regulation. And so we can't advertise like a mutual fund. I can't today present my track record and try to sell you all on that. That is not what we can do. We can only offer our products to sophisticated people in a private way, meaning you have to have certain requirements with regard to net worth, also if you're an entity with regard to assets under management. And you will have to ask me for that. I can't push that out to you. So you'll see if you look on our website, there's things that you have to say, you're accredited and things like that. I can't go on a TV show and try to sell my product. We're really tied to a certain type of thing we can do with our data. Most people think of the hedge fund universe as being, giant and global. I think of it as, I've learned it over so many years that while there's over 6,000 hedge funds, I've met probably most of them. A lot of people in the business probably have had about 3 jobs. I probably have met them 2 of those 3. I know that's unbelievable, but it happens all the time. Hedge funds are largely trading marketable instruments, although a lot of the press certainly is talking about other elements that some do trade. Most of the funds that we're invested in, they're marketable instruments. They're marked on a daily basis. Obviously, the history goes back a long time to 1949 when the first hedge fund, which is trading long and short equities, a pretty basic hedge fund, was started. Most people talk about the fee structure because in our business you get paid for performance. And so we take a percentage of profits, the hedge fund manager takes a percentage of profits. And so it's an entrepreneurial business in that if there's no profits, you really don't make any money. So that's just the little basics. Now, a fund of hedge funds, which is what I run, and so I pool investor capital and I allocate it to investment strategies and select hedge fund managers on a global basis. What I'm really trying to do is identify sources of alpha that the managers can produce and then form portfolios of this that are very robust. And so the benefits to an investor are they don't, one, have to do the portfolio allocation, don't have to travel all over the globe looking for the best people to then execute those strategies, and also they don't have to do the ongoing due diligence, which is really 90% of our work. It's not the initial due diligence, it's really ongoing and knowing when to adjust your portfolios. It's very difficult for most investors to rebalance their portfolios. And we certainly have seen over the years that most people want to ride their winners, and hardly anyone will ever cut back on them. And the losers they'll abandon right about the time they should be adding capital to them. And so human nature kind of trips up a lot of people in portfolio management. So having someone and a team that's professional to do that is usually pretty helpful in the long run. The way that we do it is we allocate to strategies and managers, and we try to decrease the volatility of that portfolio by using the portfolio hedge component, which I'll talk to a little bit. But here's a little background. Our industry today is about $1.5 trillion. In the fund of funds universe is about $560 billion today. The industry peaked at about 1.8, which was at the beginning of 2008, pretty much. So people talk about our industry kind of contracting, but it really hasn't contracted that much, especially after the years of 2007 and 2006 were really robust growth years. And so we're really just kind of back to the 2006 level and coming back. The fund of funds industry peaked at about $800 billion. And the difference is really there's a few large fund of funds that had a lot of issues in 2008. And that really has knocked that number down dramatically. This is just showing you a little bit about the growth. And what I've done is include years in the first columns. And then I just showed you the quarters. So 2008 was the first year that we had any contraction. And then you'll see that the quarters after that, we had some contraction for 2 quarters, but now we're back up. And so money is flowing back into the industry, and we're certainly growing again, both as an industry and our firm too. This is the number of hedge funds. It peaked at about 7,600 hedge funds. Today we have about 6,800 hedge funds. And so while the number's lower, it's not really as dramatic as most people are thinking about it. I've been in the industry for a very long time, and even back when I first started allocating to hedge funds, there were probably only 75 non-commodity hedge funds in the world, so it was a tiny industry. Even at that time, we had about 10% turnover a year. In a normal year, even when it got to 7,000, we probably had about 10% turnover a year. Last year, we had about 20, 22, 23%. I'm not that shocked because, 2006 and 2007 were robust growth years. A lot of people came into the industry. And then 2008 happened, and that was their second year in business. Well, I was very happy that it was my 21st year in business. You're going to obviously have much harder time raising money, retaining your staff. So it's not that big of a surprise to me that the contraction in number of hedge funds was as dramatic as it was. Also, that you have to remember that in our industry, it's dominated by the biggest players in the industry with the most capital under management. And a lot of firms, I would say probably the bottom 40%, never really have that much capital under management. So even if they're going out of business, it's not affecting the overall assets under management very dramatically. They never really either had a sustainable edge in their trading strategy or raised the capital that they needed to sustain their business. Now, this is a little bit about the fund of funds industry, which obviously I have great interest in. So it shows, these are the numbers since 1990. Again, it peaked at about the 800, and now it's about 560. And this is showing just a small decrease in the last quarter. We're definitely getting a lot of RFPs, requests for proposals, and capital's definitely flowing back into the industry. This is something that few people know about the industry, is what percentage of the assets is really controlled by fund of funds. So it's almost 40% of the entire industry is controlled by the fund of funds industry rather than directly allocating to investors. And this is the top 25 fund of funds in the world, and we've always been in the top 25 since we started in business, and we are still. They manage over 70% of the fund of funds assets, so it's really dominated by the top players in the business. It will be increasingly so going forward because of 2008 and the dislocations. A lot of the fund of funds had started in the last 2 to 3 years, not in the last year, obviously. And so they didn't really have enough assets under management or track record to succeed. And so I think in the long run, this number is going to be quite high as it was before. I thought it'd be interesting to kind of step back and talk a little bit about why would someone be interested in investing in hedge funds or in a portfolio of hedge funds. And to understand how most people think of investing, I thought it'd be good to look at the stock market, and this is the Dow since 1900. So I'm including a lot of data here, but most people, at least my age or older, think of a buy and hold equity strategy as a winner. And they think that way because look at the last, other than what's just occurred, the last 30 years of data. The market really has gone up, and gone up quite dramatically in the long history of the market. And so most people that have any tenure in investing have been allocating capital in a robust equity market. So this, you'll always win if you buy and hold has been kind of the mantra. Well, if you really step back and expand things, you'll see that there have been very long periods of time when just allocating to equities, which is what the majority of people in the investment field do, would not have been a winner. And those times are really long. So the first time, 25 years, that an allocation to equities wouldn't have helped your portfolio. That's some people's whole career. The next time, it was 16 years where equities didn't make another new high. And today, we're about 10 years into it where equities would not have really helped you. So despite the fact that we've had a run-up in equities, which I think is pretty much a head fake on what's really happening in the world, this could go on for a long period of time. It could go on for another 10 years. So when you're looking at how to allocate capital, whether it be all of you when you start working in your 401k, or if you're running foundations or corporate cash, you really have to think about what else can you do with your money, because maybe you have liabilities that you have to fund if you're a pension, for example. Well, when you look at the hedge fund community, we don't really care if the markets are going up or down. Our numbers are uncorrelated to what's happening in equities, and so it really is an alternative. And that's how we get the name, alternative investment strategies. We're not just long equities. We don't just own them and wait for them to go up. We're not just long bonds. We can go long and short and make money no matter what is happening in the market. I thought it'd be interesting for you to see an example of a fund of funds. And this is a diversified portfolio. And this is a current allocation, actually. So this would be something that someone would have in their portfolio today. When you're looking at this, we have 6 strategies included in this portfolio. And I'll talk a little bit about some of the opportunities that we're seeing and why people are leaning to credit. So you look at that allocation to long-short credit, and these are managers that are investing in securities of companies going through bankruptcies or reorganizations. So you can imagine after the dislocations of 2008, how many companies are really in trouble. They had gone through a really very positive part of the cycle. A lot of these companies had been taken over by private equity firms, had been leveraged up, and now they're going into 2008 having trouble with their businesses, can't pay their debt. They just can't meet their obligations. They have to then either file for bankruptcy, file for reorganization. Our managers take advantage of that, meaning that they actually will invest in the different tranches of the debt of these companies. So let's say that a company has 28 tranches of debt, which a lot of these companies have very complex structures. It's our manager's job to figure out which of those tranches are not being valued correctly. So let's say the top tranches are being valued at 80 cents on the dollar, the middle tranches are mostly 40 cents on the dollar, the bottom tranches are 20 cents on the dollar. People don't think they're going to get paid when they reorganize this company. Maybe our managers can find the tranches that are mispriced. Maybe they can identify a tranche that in reality is secured by a Canadian subsidiary's assets. And they read these bond indentures, have understandings of the capital structure, what assets are there, and they believe that that pricing will come back in that reorganization. This is an area where at the beginning of 2008, we had about 13% allocated to it, and now we have 24%. There's two reasons why. One is we've been through bad cycles before. We had a drawdown in 2008, and this was our fourth one in 22 years. We know there's a lot of dislocations that happen after that, and we moved capital to those areas to take advantage of it. And you'll see when you look at the returns for the 9 months on a portfolio like this, and you look at that long-short credit, we're up over 50% in that sector for 9 months. So there's a lot happening. We're seeing our managers refreshing their portfolios and really taking advantage of that. Another allocation that's pretty large right now is long-short equities, over 30% of the portfolio. Now, these managers can be either geographic specialists, let's say they specialize in just the UK or just Asia. They can be sector specialists. We have teams that just do healthcare, just do technology. They're experts in their field. Or we have generalists. And what they are trying to do is buy the companies they believe have fundamental value better than what the price is at and hoping for those companies to go up, or they're shorting companies where they think they're not going to survive, that they're mispriced, either they're hyped, sometimes they're frauds. There's something where there's winners and losers, and that's what they're trying to do. They're trying to bet on each side of that to make money. There's a lot of talent in long-short equities, and most of the managers that we see are in this area. Then macro, these are managers that are investing in currencies, bonds, stocks, commodities. They have a very broad palette to express their views. A lot of this in the last couple years has been in the fixed income area. You can imagine what's happening to many of the, not just in the US, but European relationships in fixed income with all the easing that's been happening on a global basis. There's a lot of dislocations, and a lot of the capital has been put to that. Now, you'll also notice in the chart of returns, they're only up 4%. I've been saying for 2 years that there's so many dislocations, this should be the area to be in. I'm still saying it, and I'm still waiting. So I believe that managers should be able to capture it. Managers are having a very hard time. And a lot of that is the government, governments getting involved in things. And so relationships are skewed, or things are occurring where the managers are having a hard time predicting that. Multi-strategy opportunistic is just that, managers that can allocate to the various areas. Today, our managers are about 50% in credit, so they're seeing what we're seeing, about 30% in equities. And then an interesting thing that's happening just in the last few months, mergers are happening again. And you'll read it. I'm sure you read the paper, the FT or the Wall Street Journal, any paper really. The companies are beginning to merge. Mergers and acquisitions as a trading strategy, we didn't have much going on for a long time. And now they're coming back. Companies that are weaker have to go with companies that are stronger. Or there's hostile bids for companies now because their stock prices are so low. So it's really interesting. Activists are managers that take big positions in companies and try to work with management on a friendly or unfriendly basis to realize the value of that. And so these are the people you read about all the time in the paper. in our database, we keep a very robust database of all the managers and every article about managers or their positions. And the activists by far have the majority of, even though small allocation of capital, of our space as far as press clippings and things. Now we have just 7% in that, and that's because this is not going to be a great environment for them. This allocation is actually going down to about 2%. We're moving capital away from this. The activists benefit from a robust equity market or from a time when they can borrow money or the companies can borrow money to really realize transactions, and this is going to be a tough environment for them, so we're moving away from that. But this just gives you a little idea about what a portfolio would look like. A multi-strategy portfolio like this normally has, on a look-through basis, leverage of about 2 to 1. Our managers went down to about 0.9 to 1. So after 2008, as it proceeded, they really pulled back on their portfolio, pulled back on their grosses, pulled back on their nets. That's inching up, and it's about 1.5 to 1 today. Our managers, on average, have about a 10-year track record, and on average have about $3 billion under management. So most people think of them as being new. Most people think of these firms as being pretty small, not necessarily. Our turnover in our portfolios is about 15%. I just included these definitions, and they'll be in the slides that are available online, but I just described them for you. One of the most important things in our industry is the selection of the managers. So obviously getting the portfolio allocation mix right among strategies is very, very key. So going to credit when credit's going to be robust. But the second thing that's very different than traditional allocations in investments is in alternatives, the difference in performance within the manager group is enormous. So finding the best managers for each of those strategies is imperative. And what I've done here is on the right side, you're seeing traditional asset allocations. And so traditional managers, be it mid-cap growth or large-cap value. And what I've graphed is not the best and the worst. What I've shown you here is the 25th percentile manager and the 75th percentile manager. And the performance differences on traditional asset classes is only about 6%. So if you pick the worst or the best, in that group, 25th percentile, it just won't matter that much to you. Look at the differences for alternatives. 35% difference, 25% difference. So the fact that we're up 50% for 9 months in credit is definitely telling you we found the best credit people and the people that can take advantage of that. Because if you look at the universe, it's not going to be like that. So in our industry, it's not good enough to get the allocation mix right. You have to find the talent. And we are on a mission to find the best talent. I thought it'd be interesting for you to see that time frame. When we looked at that other chart of the equity market, I graphed here equities since 2000, so when equities kind of had some issues. And then a portfolio, a multi-strategy portfolio, to say, well, if you had allocated to equities, what would have happened? You would have been down 14%, and that's from 2000. 9 years of your money you would have allocated to equities. And most people in the United States put the majority of their money in equities. And after all the work you did, you would be down 14%. 9 years, cumulative. In a portfolio that was robust and diversified in hedge funds, you would have been up 111%. And that's net of all fees and expenses. And so that diversification, that alternative approach would have benefited you during this challenging equity time. One of the things that I think to understand that other chart and some of the things you can accomplish with alternative investing, it's important to look at different time frames. And what I've done here is I've graphed 261 months. And so that's 21 years and 9 months of data, a lot of data. And I've then shown you what a diversified portfolio of hedge funds would have achieved on a monthly basis net to investors. It would have earned 88 basis points a month. That's a long time, 21 years and 9 months. What would equities have done over that time frame? I use the S&P here. It was up about 75 basis points. In the middle, I've graphed up S&P months. So there were 167 months where the S&P was up. What would that diversified portfolio have done? It would have been up about 1.1%. But the most important thing to investors is the far right side. When the S&P is down, it's down on an average of 3.6% in a month. Huge. A diversified portfolio is positive of 38 basis points positive. That's what an investor really looks at. What can you do in your whole portfolio management to mitigate those down equity months? And you diversify. And you can diversify in a way that you can accomplish that. Part of the key to that diversification, if you look on that prior chart, is the portfolio hedge component. So I didn't mention that when I was going through this because I really want to emphasize it. These are, for the most part, managers that are shorting securities. And it's an area of investment management where it's very hard to find talent. We will go long, far, and often to see short sellers if I hear there's talent somewhere. We're big believers in this. In your portfolio management, if you want to have a robust portfolio that doesn't really relate to what's happening to the direction of equities, you're going to have to hedge that in some way. Now, obviously, you can hedge it by diversifying among strategies, among managers, but a portfolio hedge component has worked for a long period of time. And so when you look at some of those numbers that are coming up here, why can we do well in a negative equity market? It has a lot to do with that portfolio hedge component. And then remember, I talked a little bit about how investors have a very hard time in portfolio management, kind of holding back on human nature, not riding your winners and cutting back on your and adding to your losers. Well, in portfolio hedge, that's definitely the case. So when short sellers are losing the most money, we have to be contrarian investors and fill up that bucket again. Because when the equity markets are turning, they have to be there to protect us. This is just showing you a longer-term track record of an example of a fund of funds and what would have happened versus the S&P 500, the Morgan Stanley World Index, and so obviously you have to look at world equities, the bond index, which is the fourth column, and then a traditional portfolio of 60% stocks and 40% bonds. And these are all net numbers. And so you'll see the portfolio that's diversified among hedge funds would have returned about 11%, equities in the US about 9%, world equities worse, about 7%. And then you look at that standard deviation, which is only about 5% on this diversified portfolio, and you look at equities either in the US or global equities, it's about 3 times that, about 15%. And so you are able to diversify and to lower that volatility. Below, this is a regression of the monthly numbers, so that's that 261 months, against the S&P 500. And the alpha generation on this portfolio is enormous. It's about 79 basis points a month versus you saw that return of 88 basis points. So almost the entire return from a portfolio is alpha generation, which means return that's unrelated to what's happening in the market. It's purely talent return. And then the beta and R squared are really 0.1, and so it's not at all correlated to what's happening in the equity market. People are always looking for investments like this, and I think this is why the industry has really been popular and growing dramatically. One of the things I thought would be interesting would be to talk about what's happening, what's the landscape like after all the dislocations of 2008. And it's probably one of the most interesting times I've ever been involved in investing because the dislocations have created so many opportunities, be it in credit, long, short equities, on a macro scale. Anytime there's big dislocations, you should be able to find talent that can then capture some of what's happening. The other side of it is there's enormous capacity in our industry right now. When I first started in the industry, there weren't enough managers to allocate the capital. We used to have to actually convince people to go in the industry. One manager that's a huge hedge fund today, I can remember sitting at his kitchen table with him. He had quit a bigger shop and saying, you really need to go in business for yourself. You know, you have such talent because everyone needed capacity. Well then, obviously, 20 years later, you look at what happened and managers were closing before they opened. People who shouldn't have raised money were raising $1 billion before they even started a trade. And so our industry was very capacity constrained for a while. That is not the case today. Most managers are open and we can get people that are very talented to manage our capital. But the other side of it, to truly understand why it's such a good time, is there's a lot of investment houses that are just out of business. And so you look at some of the bigger institutions, and we all know the ones that have bailout packages, the bigger banks, they all had investment trading desks that were competing with hedge funds. Most of those have no capital or are literally disbanded. So our hedge funds have a lot of free rein to make money now. So it's a really good time. The other side of it is, remember I talked about the leverage in the portfolios. Normally it's about 2 to 1, and now it's only 1.5 to 1. Our managers have very robust returns and aren't even using their whole balance sheet. And so they can really expand as they see more and more opportunities, and obviously that'll mean higher returns. Now I thought we for sure should talk about regulation, since this is in every paper every day. The FT just had an article about regulating compensation now in Europe for hedge fund managers. There certainly is a lot more regulation coming. I think there will be a requirement for hedge funds to be registered. I welcome that. We're a registered investment advisor and have been registered the entire time. A lot of the managers we deal with are. I don't think it'll really change much. Most managers set themselves up to have the staff and what is needed for registration a few years ago when they were talking about doing it and then didn't. And so I don't think it'll change the industry much at all. The other regulations can be troublesome. When we saw 2008 and they had that short selling ban, normally when governments are going to regulate an industry, especially the investment industry, they'll come forward with a proposal. You'll have so many days that you can, usually months actually, come back and say the effects that will occur. And then they adjust it. They come out with a white paper on it. You know, there's a system of long period of time for people to respond so that the regulators can understand how it will impact the industry. But the other side of it is it gives the managers themselves a lot of time to adjust their portfolios for the new world. That didn't occur in 2008. The short selling ban literally happened at night. I was at a Little League game, and you know, my BlackBerry buzzed, and I looked at it. It was my partner saying, they may be regulating us out of business. You know, so you're a little shocked. The managers were shocked that they didn't have a time for really discovery about what they were doing and how it was going to impact the world. I think now we all realize that that ban, in fact, decreased a lot of the liquidity in the market and really impacted it in a very negative way. If you looked at banking shares and financial services stocks from the ban through the year end, they went up, you know, I think it's about 60%. Well, I don't think those financial institutions were doing better in that time frame. And of course, our short sellers that held on to those positions made money because those companies went straight down, but it was following in 2009 where they made their money. And so regulation is definitely there. I think there was a lot to be learned by what happened in 2008, and I think the regulators are very cognizant of that they need to know what they're doing before they actually put this regulation in place. It's interesting to me that so much was said after 2008 about a lot of regulation coming forward, and very little has actually happened. So, you know, they talked about an uptick rule, they talk about a lot of things, but nothing's really happened. So that's interesting. This is just showing you long-short equities is one of the areas of opportunity. And what this is showing you is correlations. I'm showing you 22 years of data. So what happened in 2008, that spike over to the right, doesn't look as dramatic as it really is. But this is 12-month interstock correlation for the S&P 500. It went above 60% in 2008, which is a historic high. It stayed there, amazingly, for 16 weeks. So this means that interstock correlation, everyone was dumping U.S. equities at the same time. It didn't matter what their fundamentals were. Good companies, bad companies, people wanted cash. So correlations went above 60% and then stayed there 4 weeks. You may never see this again in your life. It was almost impossible to make money in long-short equities in this time frame because nobody wanted to hold an equity. And so when companies are not trading based on their fundamentals, whether they're good companies or bad companies, it's really hard for managers to make any money. You see that correlations are coming down. They're still high, but coming down, and the managers are making a lot of money on the long and the short side. Companies are starting to trade based on their fundamentals again. This is the credit market. And so, one of the things I said was, I think there's going to be a lot of money made in credit, both long, short credit. And these are companies going through bankruptcies and reorganizations. And you may say, well, why is that? What I've charted here is the percent of defaults that's occurring now. So you look and it's about 14% in 2008. That's a high for a long period of time. And it's continuing. What's going to be different about this credit cycle is it's going to last a long time, and it's going to be very broad. So if you look at other peaks in this credit cycle where companies were filing for bankruptcy, you'll see that one, it's a lot lower than it already is, but it was very different. Normally, it was more US-centric, and it was more specific to industries, let's say tech, for an example. This is going to be crossing sectors. And so what we've been seeing is automotive first, then automotive suppliers. Housing, now housing suppliers. Now we're starting retail. Then it's going to be retail suppliers. And so this is crossing many, many sectors. We believe that this is going to last 4 to 5 years, and that it's starting in the US, and then it's going to go to Europe. And so it's also going to be much more global credit cycle. Companies are getting in trouble. They're not going to be able to get out of it. And to give you an example, Bank of America recently estimated that $145 billion of defaults will occur this year. Next year, $130 billion of defaults. 2011, $120 billion of defaults is estimated. Now, to give you a frame of reference, in 2008, that number was just 20. And so companies have balance sheets and leverage within them they're not going to be able to get out of. They're not going to be able to pay their interest. They're going to default on their debts. They're going to have to go through bankruptcies and reorganization. And our managers in the long-short credit will be able to take advantage of that. So it's an unusual time for you all to beginning your careers, but I think it's a time of opportunity. As I said, I think it's going to be a little tougher to get your first job because you don't have a lot of experience in general. But once you get it, I think in the investment fields, there's going to be a lot of opportunities out there, and firms will be quite robust in their returns. And at least in the alternative area, we really mostly get paid by a percentage of profits. And so having that opportunity set in front of you will probably be a very good thing for a long period of time. Well, I gave you a little of all those topics that I mentioned, and I thought I'd open it up to questions. And so if you have any questions about the industry or my career or anything at all, please feel free to ask any questions that you have.
Okay, if you would come down to the microphones to ask your questions, if you'd like to record those, please.
Hi, I'm a first-year MBA student, and I'm trying to make a career change from I worked as an engineer prior to being here, and now I'm trying to go into asset management. And I was wondering, where do you recommend would be a good place to launch a career where you can really learn how to manage money well? Would you recommend going to like a big bank, or would you recommend looking at small boutique-type firms?
Sure. Well, change of career is the hardest thing that anyone can do, and it doesn't really matter about your talent, I think. I just think it's hard for people to accept the fact that you had this interest, and now you have this interest. And I'm a product of that. And so when I started my career, I was an auditor. I was in accounting. I loved it. I loved public accounting. It was a great place to train. They review you every 2 weeks. When people tell you what you're doing wrong every 2 weeks, you correct your behavior. And so I always think of public accounting as dog years. It's 7 years for every 1 year you're there. But when I wanted to leave public accounting, because I thought after about 5 years I had learned a tremendous amount, the learning curve was wonderful, but I really wanted a little more, and I wanted to go into finance. I had a really hard time, even though I think my credentials were pretty good, convincing people that I really wanted to do that. And so what I did was what you're doing right now. I decided to go back to graduate school and prove it. And so I went to the University of Chicago. Obviously, I had to go in Chicago for a number of reasons, one of which I went at night, and so I was working full-time. But once I got into graduate school and I was focused on finance, everyone took me seriously. So when I started interviewing, people really thought this was work. And I moved to investments in my first quarter of graduate school. So you have to do something to prove to people that you are serious. You are obviously doing something to do that. I think the best training ground would be smaller firms right now, especially for investments. I think there's a lot of larger institutions, banking institutions specifically, that just don't have very robust trading desks right now or don't have the capital to do it. If they're allocating capital to things, it's very hard for them to allocate capital to the investment desks right now. There's a lot of restrictions on a lot of institutions. I went to work for a very small firm. The advantage of doing something like that is they can really watch you and they can recognize if you have skill sets very quickly. When I started there, and I really did not know much about the investment field. I mean, I had audited investment firms, but I didn't work in an investment firm. I was an accountant and an auditor specifically. When I got there, we're in our first meetings and they're talking about different elements of the portfolio. I don't think I really realized how much I knew about the world or about investing until I got there. And people were talking and, you're the new person, you're sitting there and you're thinking, well, they know this, right? And then no one says it. And all of a sudden you think, I got to say it. And so you bring up things and, oh, really? See, I had seen a lot of investment firms. And so I had things to bring to the table. And so at a small firm, they recognized that. I was asked to be a partner there 14 months after I got there. Because I think I had also started my family. I had my son Danny at the time, and I think there was a certain fear that I wasn't coming back. And so they thought, oh, let's make her come back, which helped, which is fine. But I think a smaller firm. I think you get a lot of hats to wear. I always think when you are starting out, there's a couple favors you can do yourself. One is have a good attitude and be flexible. Even if they hire you for this job, if you see they need help over here, help out. I think attitude is everything. And so I would say a smaller firm.
Thank you.
Sure. Would there be more questions if we didn't make you go to the microphone?
You mentioned how there was some increasing regulation going on, especially towards your business, and how you were almost fearful that you might be limiting your opportunities or possibly shutting down your business around 2008. How are you preparing yourself to deal with any potential future regulation?
Right. Well, it's funny because we certainly have hired people that understand it, and we're involved in an organization as a industry now where we weren't before. And so, you definitely want to have an organization that's representing your industry and lobbying to make sure that regulators understand the impact. I think sometimes they're doing X because they think Y is going to happen, but in reality, they have no one in the administration that really has ever been in the markets. I just heard Geithner speaking. He spoke at the Economic Club in Chicago, and we all went to this. And it was one of the things that he said. He said, I've never worked in the markets. So I think you have to be much more proactive, and our industry is much more willing to represent ourselves in Washington. If you look at all the testimony that's occurred from hedge fund managers, almost all of it's happened in the last 18 months. And so the industry has really taken this charge on to make sure people understand the impacts, not just on our industry, but on global financial markets, which I think wasn't understood. So I think it's really important to get involved and then to be abreast of what's coming forward. And so normally our regulatory update at our quarterly meetings would be 30 seconds, and now it's 30 minutes, every quarter, because there's so much happening. Or so much pending. Not much happening, but a lot pending. Sure.
All right, great. I'm just going to pull this out. All right. Kind of staying on the regulatory frame of mind here. I've read a lot about there's a tax loophole, basically where a lot of hedge funds can get away with having their income being taxed as capital gains instead of reporting it as corporate profits and having it taxed at the tax rate that every other company is forced to be taxed at. So could you talk a little bit about that?
Sure.
And do you see that changing anytime in the near future?
I think it might change. It definitely is one of the advantages of being paid as a percent of profits that are generated. Because of that, you got the characterization of the actual investments often, which is unusual. And this really started changing, I think, when Blackstone went public. And it became pretty apparent to everyone that this was occurring, and it was occurring on a very big scale. I would not be surprised at all if that didn't change. I would be sad, but not surprised.
Okay, you just decided to go into a traditionally male market, especially in maybe 1977 as opposed to now. But could you describe a little bit of the experiences of being a professional woman and what it took to get through the ranks and become successful?
Oh, sure.
And then also balance that with your personal life where you've been married and have children and being able to balance everything out at the same time.
I think one of the reasons why I went into investing is, and times were very different then than they are today, but certainly they're not perfect today either, in the investment world too. But when I started in public accounting, I had a lot of different clients. So I was a melter and smelter, that's what they called us. I had a lot of steel companies. I had some hospitality companies, a lot of manufacturing companies, and we had merged with a public accounting firm that had a lot of commodity clients. And back then, as I said, most of the hedge fund industry was commodity related. Well, when I looked around the boardrooms of some of these companies, especially manufacturing and steel, I didn't see any women. And so I thought, this is not going to be, the area that's going to be a long-term winner. And I had a lot of interest in continuing to work. And so I thought, when they asked for a volunteer to learn this new industry, I volunteered. And I volunteered for two reasons. I believe in life, you have to figure out what you're interested in and specialize. Be an expert. When you specialize, doors are open to you for a long period of time. And I wanted to go into something where the investment field is kind of the thing. I always say, you could be a green Martian. If you make money, you're going to be successful. And so I felt that people would look at the results more than some other industries. And so I really wanted to lean toward finance and lean toward investments because of that. Obviously, that's proved to be true in a lot of ways. The way that I found, there's a couple things that over the years you learn about balance. I think I have a very balanced life. And I think a lot of people in our firm do too, most people. When I talk about culture, one of the cultures we have is from very early in our existence, we have offsites both with the partners and with the management team where we make big decisions. And I think you have to get out of the office and you have to really make... And some of the decisions we made were based on how we wanted to live our lives. And an example would be very early on, a lot of our competitors were really going after the Asian market in a big way and expanding with separate account management and Asian assets. We decided we weren't going to really go after that. And not that we don't have it, because today we certainly do, but it came in very different ways, and we have a very robust business as far as capital. But it was because we didn't want to spend 2 or 3 weeks at a time away from our families. We all had young families. I still have a young family. Actually, most of us had our last child into our 40s, which is very unusual. But in the investment community, at least in ours, that's what we've done. And so for that work-life balance, we decided not to really go after that business. And so we grew a little slower at the beginning than our competitors, but certainly have caught up over time. And we have, I think, a much broader business than most as a result of that. So there's decisions you make. The other side of it is that my husband also runs an investment firm. He runs a private equity firm and is also very involved in community work and He is the chairman of the Loyola Business Council, actually, which is kind of funny. So we have really very robust lives. Very early on, we decided that one of us would be home, and we would have our travel schedules meshed like that. Now, it's a lot easier today because he runs his business and I run mine, but even in the early years, that's what we did. And so someone was always home, and we still do that. Last night I was here, he was home, then 2 nights before that, he was away. And so we've coordinated our schedules so someone's always home for the kids. Now, we have one at home still. And the other thing is, I realized very early on that the caregiver for our children would be a very important person, not only in their life, but specifically in mine, and not as much in my husband's. And so when I interviewed for that position, I made sure she realized she could have a career with us, and that I valued what she was doing. I'm not a micromanager, either at home or at work. She has a career path, and she has a lot to say about what happens. I also wanted to get someone that had a personality like mine. And so an example would be, if it's a sunny day and the choice is do laundry, clean the house, or go on a picnic, always pick the picnic. And so I made sure I found someone like that. There's always time to do this other stuff, And I also gave her the task that's a very broad mandate. I said, if I was home and I did it, you do it. If I wouldn't do it myself, you don't have to do it. So she does a lot of tasks. I'm not saying do this. I'm not giving her tasks. I'm giving her a life. And so we've had one caregiver the whole time, and I think that's very, very important. We've definitely become a family. She has definitely become our extended family. She now has 2.5-year-old twin girls, which are also part of our life. And it's been really beneficial. And I think it's a key ingredient is to figure out what's important to you and then make it happen for yourself. Anything else?
We have a student coming up for a question.
So I know you've been in this industry for quite a while and probably seen a lot of change over the years. What do you think the next 10, 15 years, how do you expect the industry to evolve?
Sure. That's probably the most interesting thing about being in an industry from the beginning is, as I said, when I started, there were probably 75 hedge funds, and most of the funds that were managed were commodity-oriented, and a lot were actually in Chicago, so it was a great place to start. Also, all the investors were individuals. Institutions really didn't allocate to it. And so 95% of our capital was just from high net worth individuals that allocated, and institutions were a tiny bit. There were a couple institutions that very early on saw that this was a way to diversify. If you look at the business today, it's 85% institutional and 15% individual. So huge changes. And a lot of that is, if I get an individual that gives me $20 million or $50 million, that's a big individual. An institution can give me $500 million, $100 million a quarter for 5 quarters. So you see that the institutional capital can swamp the individual capital as far as assets under management. The other thing that really changed our industry was the internet. To get a client, I was in Chicago early in my career. Most of my clients were individuals in Chicago or their friends that lived in New York, California, Arizona, or Florida. Those were most of the people that I had, and it was word of mouth. Once the internet really took off, if you're searching today and you want to allocate to a diversified pool of hedge funds, and you do that search, we're going to come up. We have a 22-year record, a very solid record, a big firm. People will find us. Well, what's happened today is I'm as likely to get a client from Australia, Asia, Europe, United States, anywhere. 11% of the capital I manage is from Australia. Now, this is all done over the internet. Also, another change in the business is that consultants adopted it as an asset class. And so when consultants would allocate, would do portfolio allocations for their clients, be it individuals or institutions, largely they did stocks and bonds. Then they put some alternatives, and that was real estate or oil and gas. That was kind of what timber maybe, and that was all of 2%, 3%. Well, once alternatives got in that mix and it was accepted by consultants, institutions started allocating 2% to alternatives, 3%, 5%, 10%. There's institutions now, and we all read about them, especially educational pools of capital, that are largely all alternatives. So consultants themselves changed the way they looked at their asset mix. And when a consultant puts alternative investing, let's say he's saying to all his clients, I want 10% of your money to be in alternatives, I want 7% of that to be in hedge funds, we're their solution. And so consultants would have us in their database, they would have done enormous due diligence on us, and then we're the solution for their clients. And so capital started coming in that way on the institutional side, which was in really big changes. As I said, when I started in business, it was really hard to find talent. Like you almost had to create your own talent. When we look at how many managers are in our portfolio where we were day one or year one capital, it's an enormous percentage of them. Well, some of those managers have been with us for a very long time. But we used to have to convince people to take money in separate accounts and do things like that. We had to create the industry at the beginning. Well, then it became such a lucrative industry. People were coming into the industry in droves that had no talent. We were meeting people that had no talent, no experience, no sustainable edge, no real business. They were in there just to make money off because of the performance fees. So this is now the opposite side of the industry, from trying to find talent and convincing them to, going through and meeting all these people and figuring out who we should pay attention to. We had to develop processes within our investment firm just to do that. We had to start rating people, 1, 2, and 3. We pay attention to the 1s, the 2s we keep an eye on, the 3s, forget about. So there's different types of triaging we had to develop as an investment firm to handle that. Now we could have 20 managers coming through in a week. We used to have 20 managers coming through in a year. So the business really has changed dramatically in many, many, many ways. When I look forward, the business is definitely going to be more regulated. But I will say that more and more talent will start coming to our industry. And, part of it is you look at some of these larger institutions that now have all these dictates about compensation. The government's actually limiting compensation. So if you were a talent, and you're starting to see that, and you worked for a big bank, and you ran an very successful investment desk, and you negotiated a percent of your profits, you can no longer work there. So what you're starting to see is these desks being spun off because they're going to be standalone investment firms because they want to retain that compensation. So more and more talent is going to come into our industry, which is very exciting for me. When I spend a lot of time on a lot of things, but the most exciting thing for me is finding a manager somewhere where I think I can put money with him or her for 5 or 10 years and have a partnership for 5 or 10 years where they can make money, I can learn their industry. I mean, that's the most exciting thing, is finding talent. And I think there's going to be a lot more talent in our business. Also, the other side of it is 2008 made people realize my business is a lot harder than it looks like from the outside. And 2008 proved that. I was just reading... was at the Wall Street Journal this morning, yeah. And it was about a big house, and they started a fund of funds because they knew about investments and how they're closing it down because they were down 40% in 2008. It's a lot easier from the outside than it is once you start. So I think that's going to be good for us.
Do we have other questions? I think we'll close out with one last question then, Roxanne. You probably piqued the interest of a number of students in here, both from a sense of personal investing in the future. Not too many will have $200,000 incomes just yet, but
very soon.
There's going to be some. What would you say would be the next step the students should take if they really have an interest in understanding what hedge funds means and how to use them? Is there a book, a course? What would be the ideal way to?
There's a lot of books now. For years there was nothing, and if you wanted anything, you'd have to write it. And actually, we were talking a little bit about some of the position papers we've written and some of the white papers we've written on topics because people, especially the press, write often about topics, and then you think, that's not really how it happens. We have data, and we can come back and say, this is really how it is. So I think there are a lot of books now written, and some by hedge fund managers themselves, which I find interesting, but of course it is the area I am interested in. So I would search out some of those and read them. I think also, when I started in the business, there was not one article about hedge funds ever. Maybe they talked about Michael Steinhardt and they talked about Jack Nash at Odyssey. But other than that, and Julian Robertson, but that was actually later. But other than that, the press never picked it up. Well, now, you pick up the Wall Street Journal, there's going to be 3 articles on the front page about our industry. Now, some of them not good. But, there is a lot to read about. And certainly a lot of publications that focus on our industry. A lot of magazines, both academic magazines and other magazines that cover the industry, which have very in-depth articles about the industry. Well, thank you. Thank you for all your time. I appreciate your attention.
Thank you so much. We really appreciate it.
Thanks, Sam.
Thank you. And remember, next week is our last lecture, 10:40, next Friday. Thank you.
And good luck in your careers. And I was told that I should mention that we are looking for a couple interns and a couple beginning positions. So feel free to send us your resumes.